sleek, glass-walled office towering over Wall Street. The lights of New York City shimmer below as financial analysts hunch over 6 monitor setups, tracking charts that shift like a heartbeat. There's a world of high finance where fortunes are made overnight and lost just as quickly. A world where a handful of people control billions, betting on the rise and fall of markets. This is the world of hedge funds, traders yelling into phones, fingers furiously tapping keyboards, green and red numbers flashing across screens. A polished hedge fund manager in a custom-tailored suit smirks as he watches a stock ticker plummet. He just made $500 million betting against it. It's a high-stakes game where the smartest minds battle it out, playing the markets like a grandmaster plays chess, always thinking 3 moves ahead. But how do hedge funds actually work? How do they turn economic chaos into personal fortune? And more importantly, should you be paying attention? Because whether you realize it or not, hedge funds are shaping the world around you. They've influenced elections, triggered financial crises, and made millionaires out of nobodies. Hedge fund managers don't follow the market, they move the market. The difference between a good year and a bad year? A single, well-placed trade. Today, we're pulling back the curtain. We're diving deep into the world of hedge funds, how they operate, their most powerful strategies, their biggest risks, and the masterminds who've used them to rewrite history. Welcome to the financial battlefield of the ultra-wealthy, where money moves fast and fortunes hang in the balance. Chapter 1. What is a hedge fund? The term hedge fund might sound mysterious, but at its core, it's just an investment fund with one key difference. It can do whatever it takes to make money. Unlike mutual funds, which are heavily regulated and limited in their strategies, hedge funds operate in the shadows of financial markets. They can bet against the market, use massive leverage, and trade in everything from stocks and bonds to wine, weather futures, and even the price of electricity. This is not just investing. This is financial warfare. So why are hedge funds a big deal? Because they have one mission: to generate massive returns. Whether the market is soaring or in a full-blown collapse. The story of hedge funds begins with one man, a journalist turned investor named Alfred Winslow Jones. In 1949, he had an idea that would change Wall Street forever. At the time, traditional investors would simply buy stocks and pray they went up. But Jones saw something different. He asked a radical question: what if I could protect my investments by hedging my bets? Instead of just buying stocks, he also short-sold others, betting they would fall in price. If the market went up, his good stocks would rise. If the market went down, his short positions would still make him money. It was a genius move that allowed him to profit in any market condition. It was the birth of an entirely new kind of investing, one that didn't just follow the market, but manipulated it. Hedge funds didn't stay small for long. By the 1980s, they had transformed from quiet investment pools into multi-billion-dollar powerhouses. They weren't just managing money anymore, they were shaping global markets. Black Monday, 1987, stock markets crash, but hedge fund managers like Paul Tudor Jones make a fortune betting against it. This is where hedge funds became truly legendary. They weren't just playing the game, they were rewriting the rules. As markets evolved, so did hedge funds. Today, hedge funds control trillions of dollars. They have the power to move entire economies with a single trade. But with great power comes great controversy. Some say hedge funds are the ultimate wealth machine. Others say they are the villains of Wall Street, manipulating markets, creating financial bubbles, and pulling the strings of the global economy from behind the curtain. Chapter 2. The hedge fund titans, masters of the game. Soros, Robertson, Paulson, men who played the markets like chess masters. George Soros, the man who broke the Bank of England. A smoky trading room in 1992. Phones ringing. Traders sweating. The British pound is plummeting. It was September 16th, 1992. What would become known as Black Wednesday? The Bank of England was desperately trying to prop up the British pound, but George Soros had seen the cracks forming. Soros, short it all. Every pound we can get our hands on. Soros didn't just bet against the British currency. He attacked it. He and his fund borrowed billions of pounds, sold them on the market, and waited. And when the pound inevitably collapsed under pressure, Soros made a staggering $1 billion in a single day. The Bank of England had no choice. They withdrew the pound from the European exchange rate mechanism, and Soros walked away victorious. But not everyone saw him as a hero. To some, he was a genius. To others, a ruthless speculator who brought a nation's currency to its knees. Julian Robertson, the tiger who ruled Wall Street. 1980s, New York. Wall Street is booming. Power suits, Ferraris, champagne-fueled celebrations. And at the top of it all, Julian Robertson. Robertson didn't just invest, he hunted. His hedge fund, Tiger Management, was a powerhouse, picking stocks with razor-sharp precision and making aggressive bets on winners and losers. Robertson built a dynasty, mentoring some of the most successful hedge fund managers in the world, many of whom went on to form their own funds, known as Tiger Cubs. But even the greatest can fall. The same aggressive strategies that made Tiger Management unstoppable also made it vulnerable. The Asian financial crisis. Robertson's aggressive bets turned against him. By 2000, losses forced Robertson to shut down his fund. But his influence? That never disappeared. John Paulson, the man who saw the crash coming. Early 2000s, real estate is booming, banks are handing out mortgages like candy. The American dream is thriving. While the world celebrated skyrocketing home prices, one man saw the cracks forming. John Paulson knew that the housing market wasn't just overheating, it was on the verge of collapse. Bet against housing? That's crazy. Home prices never go down. But Paulson knew. He saw how banks were packaging risky subprime mortgages and selling them as safe investments. So he did what few dare to do. He placed one of the biggest short bets in history. As the housing market crumbled, Paulson made $15 billion. It was one of the most profitable trades in financial history. He was hailed as a visionary and condemned as a man who profited while millions lost their homes. In a world where money moves faster than ever, where hedge funds wield more power than most governments, the question remains: are they the architects of prosperity or the puppeteers of economic destruction? What do you think? Comment below. Chapter 3. Hedge Fund Strategies. Now, let's talk strategy. Hedge funds aren't just about buying and selling stocks. They use some of the most advanced techniques in finance, strategies so complex, so powerful. They can shake entire economies. In the world of hedge funds, it's not enough to simply invest. You need to outthink, outmaneuver, and outplay everyone else. So, how do they do it? How do hedge funds turn market chaos into profit? Let's break down some of their most powerful strategies. 1. Long-short equity, the art of picking winners and losers. Imagine knowing not just which stocks will rise, but which ones are doomed to fall. That's the power of long-short equity. In this strategy, hedge funds go long on stocks they believe will skyrocket, and short sell the ones they think will crash. It's not just about making money when stocks go up. It's about making money when stocks fail. 2. Global macro, the strategy that moves nations. Now, imagine not just predicting a company's success, but the fate of an entire country's economy. That's global macro investing. These hedge funds place billion-dollar bets on major geopolitical and economic trends, currency collapses, rising interest rates, inflation, and global trade wars. Remember the man who broke the Bank of England? That was a global macro play at its finest. When you control enough money, you don't just predict the market, you move it. 3. Event-driven, profiting from chaos. Big events create big opportunities. Whether it's a corporate merger, a bankruptcy, or an activist investor shaking up a company, hedge funds are watching, ready to strike. Take merger arbitrage. If one company announces it's buying another, the target company's stock usually rises. Hedge funds buy shares before the deal closes, betting on a successful merger. But not every deal goes through. And when billions are on the line, some funds even try to influence the outcome. It's not just investing, it's corporate warfare. 4. Quant funds, the rise of the machines. What if I told you that some of the most powerful hedge funds today aren't run by humans? They're run by machines. These are quantitative funds, or quant funds, using AI, machine learning, and high-frequency trading to execute thousands of trades per second. These algorithms scan millions of data points, news articles, earnings reports, even social media trends to predict market moves before humans can react. Renaissance Technologies, one of the most secretive and profitable hedge funds in history, run entirely by PhD-level mathematicians and data scientists. These funds don't just compete, they dominate. And they never sleep. 5. Commodity trading. A burning oil field, a gold vault, a farmer looking over a field of crops. This is commodity trading, where hedge funds control the very things that power the world. The 2008 oil price spike, where hedge funds made billions speculating on crude oil. They even bet on the weather, using climate models to predict hurricanes that could disrupt agriculture, fuel prices, and insurance markets. This isn't luck, this is strategy at the highest level. Their strategies are designed to turn uncertainty into profit, risk into opportunity, and chaos into control. Chapter 4. The risks and the myths. But here's the catch. Hedge funds are not magic money machines. They're high risk, high stakes, and not for the faint of heart. These funds charge enormous fees. Imagine investing $10 million. Before you even see a profit, the hedge fund takes a 2% management fee every year. That's $200,000 gone. And if they do make you money, they take 20% of the profits, the infamous 2 and 20 model. Historic trading floor in 1998, phones ringing off the hook, panicked traders scrambling, long-term capital management, one of the most sophisticated hedge funds of its time, is on the brink of disaster. At its peak, long-term capital management controlled over $100 billion, run by Nobel Prize-winning economists. They believed their complex mathematical models could eliminate risk, but they were wrong. Then came the Russian financial crisis. Markets crashed, LTCM strategies collapsed, and in just a few weeks, the fund lost $4.6 billion, so much money that the entire financial system was at risk. Even the smartest minds in finance can be brought down by the one thing they can't control: reality. The 2008 financial crisis exposed just how dangerous hedge funds could be. Many had leveraged billions into risky mortgage-backed securities, thinking the housing market would never crash. But when the bubble burst, it wasn't just the hedge funds that suffered, it was everyone. The entire global economy spiraled into a recession, millions lost their jobs, and entire banks collapsed overnight. Some hedge funds made fortunes betting against the housing market, like John Paulson, who made $15 billion shorting subprime mortgages. But many others were wiped out, taking billions of dollars in investor money down with them. Many hedge funds fail. And when they do, they take billions with them. For every hedge fund success story, there are dozens that crash and burn. Some funds take reckless risks. Some fall victim to economic downturns, and others, well, some are just outright frauds. Remember Bernie Madoff, the mastermind behind the biggest Ponzi scheme in history? His hedge fund stole $64 billion from investors before it all came crashing down in 2008. So, before you even think about hedge fund investing, ask yourself, can you stomach the risk? Hedge funds promise huge potential rewards, but only for those who can afford the price of entry and the potential losses. Some of the wealthiest people on the planet have built fortunes through hedge funds. With access to powerful investment tools, hedge funds can profit in ways traditional investors can't. Low correlation with traditional investments, they can offer protection during market downturns, acting as a hedge against volatility. But there's a catch. High fees. The cost of investing in hedge funds can eat away at returns. Most hedge funds are only open to accredited investors, meaning millionaires and institutions. Markets are unpredictable. Even the best strategies can fail, and hedge funds are no exception. Hedge funds are the ultimate financial powerhouses, brilliant, aggressive, and sometimes dangerous. So, are they worth the risk? What do you think? Final chapter. The future of hedge funds. For decades, hedge funds were the domain of billionaire geniuses, investors who mastered risk, who saw patterns no one else could. But now, there's a new player in the game. One without emotions, without fear, without human error. With AI, automation, and algorithmic trading, hedge funds are evolving faster than ever. Some funds are now run entirely by machines, executing thousands of trades per second, adapting, learning, evolving, without a single human decision involved. In the past, hedge funds relied on human intuition, a gut feeling, a brilliant trade idea. But today, AI doesn't need intuition. It has data. These funds are black boxes. Nobody outside their inner circle knows exactly how they work. But what happens when things go wrong? In 2010, the world got a terrifying glimpse of AI's dark side, the infamous flash crash. In just 36 minutes, the stock market plunged nearly 1,000 points, wiping out trillions of dollars, only to recover just as quickly. The cause? High-frequency AI trading algorithms reacting to each other in ways no one had anticipated. Imagine a world where machines, not humans, control financial markets, where a single software glitch could wipe out billions. What do you think? Is AI the future of finance? Or are we playing with a ticking time bomb? Drop your thoughts in the comments below. And if you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more deep dives into the world of finance. Stay smart, stay informed, and as always, follow the money.